Welcome to another edition of the Trading Script, Markets in Motion. Today is Monday, September 16th. Hope you had a good weekend. So the markets are now closed for today, but we still have a busy week ahead with, of course, the Fed meeting and the interest rate decision coming up. Is this event going to top the markets and cause a crash for the rest of the year? Or is it going to produce a melt-up instead? That is what we are here to find out. And for that, we need to look at some charts and discover for ourselves what most investors are doing with their money. As usual, let's start, of course, by looking at the SPY chart, or the ETF for the S&P 500 index. Once again, we can see that the SPY is eager to make a new all-time high, which we may also call a breakout, giving us a new potential target of 600 on the SPY and, of course, a significant rally for the rest of the market. Furthermore, the Dow Jones has already produced a new all-time high. Even better, the HYG, meaning the bond market, has also produced a new all-time high, breaking above the 200 weekly moving average, suggesting that more upside remains ahead for the market. However, when things sound too good to be true, well, they usually are. You see, although these are very positive developments, the fact remains that many things are broken in these markets. For example, the Dow Jones represents what we call the old economy, meaning more stable and hopefully more steady and reliable companies. What's more, today we saw a new all-time high in the utilities sector, which is deemed a defensive sector. Note in semiconductors, represented by the SMH chart, not in biotechnology, represented by the XBI, and not in technology, as represented by the triple Qs. This isn't good news because all three of these aforementioned sectors are what we consider risk-on sectors, not where you want to put your money if you think the economy is about to face some trouble. So all this means that for the last few days, most investors have taken a defensive posture in the market. Again, what we have here is a significant divergence between multiple assets and sectors. But wait, you may ask, how does this pair up with the development in the HYG chart? Isn't this breakout supposed to be good news for the market? Well, let's not forget that what we have here is a weekly moving average, meaning the price needs to close on a weekly basis above it for this to be considered an actual breakout. In other words, this could still change in a few days, and we may see a rejection instead. Moreover, do we still think we're going to have a pullback after the Fed meeting? Well, to answer that question, let's look at the VIX. I don't know about you folks, but this doesn't look good. As we've been saying in previous videos, if a new uptrend is to begin soon, meaning a more sustainable one, the VIX needs to make a new relative low as the SPY makes a new high. And what we have here instead is that today the VIX opened and stayed higher, which is not what you want to see before a market breakout. Because again, this means that investors are significantly hedging ahead of a market event, just as the utilities sector is being bought. Of course, as we've said before, we hold no biases on this channel, and we acknowledge that this entire scenario, pointing to a correction in the not-so-distant future, may change in the coming days, and the VIX may still break down as the SPY makes a new high. Now, we still have more charts and indicators that we are tracking, but at least for now, this is sufficient information to keep us cautious in this market. Thanks for watching, and don't forget to comment and subscribe as we bring you more videos on market and technical analysis.